Hashtag AI Tech News, July 3, 2026. Buckle up, AI just got way more expensive, OpenAI's making a bold move, and Tesla's crushing it while Rivian's catching up. Today we're breaking down Zuckerberg's reality check on AI agents, Microsoft's sneaky new play, the cloud outage that shocked enterprises, plus the equity donation that could reshape Silicon Valley forever. Stick around because one of these stories might just change how you think about AI's true cost. Mark Zuckerberg tells staff that AI agents haven't progressed as quickly as he'd hoped. Mark Zuckerberg just admitted something that's been quietly obvious to anyone paying attention: Meta's AI ambitions aren't moving as fast as he'd hoped. During an internal meeting, the CEO reportedly told staff that their AI agent development efforts have hit a wall, falling behind the aggressive timeline he'd publicly committed to. This is a massive moment because Zuckerberg has been betting the entire company's future on AI, positioning it as Meta's next frontier after social media and the metaverse. When a CEO of his stature and influence admits progress is slower than expected, it sends shockwaves through the entire industry. Here's the context that makes this particularly significant. AI agents, software systems that can autonomously complete complex tasks and make decisions, have become the holy grail of artificial intelligence. Everyone from OpenAI to Google to Anthropic is racing to build them, and Zuckerberg has been one of the loudest voices claiming victory was just around the corner. But the gap between theoretical capability and practical, reliable systems that actually work in the real world is proving far wider than anticipated. Building AI that can reason, adapt, and handle unpredictable situations without constant human oversight is exponentially harder than training language models to generate text. What this really tells us is that the AI industry might be entering a reality check phase. The hype cycle that's driven valuations and investment for the past couple years was built on optimistic timelines that assumed progress would be linear and inevitable. But Zuckerberg's admission suggests we're hitting genuine technical challenges that can't be solved just by throwing more money and compute at the problem. For everyday people, this means the AI revolution might unfold more slowly than headlines suggest, but it also means the companies that crack this problem first will have an almost unbeatable advantage. The race isn't over, it's just getting real. A warning sign about AI's real cost, courtesy of Google and Amazon. Hashtag AI's hidden environmental cost, the net zero problem nobody wants to talk about. Tech giants are quietly abandoning their climate promises, and artificial intelligence is the reason why. Google and Amazon, two of the world's most powerful companies, have both signaled that their net zero carbon commitments are becoming increasingly difficult to meet, and the culprit is the massive energy demands of AI infrastructure. This isn't a minor setback, it's a fundamental collision between the industry's environmental promises and the computational reality of training and running modern AI systems. Here's what's actually happening behind the scenes. Training large language models and running AI inference at scale requires staggering amounts of electricity. We're talking about data centers consuming power equivalent to small cities, all day, every day. Google and Amazon have invested billions into renewable energy to offset their operations, but AI workloads are growing so fast that even their renewable capacity can't keep pace. The math is brutal: every new AI feature, every chatbot, every recommendation algorithm adds another layer of energy consumption that wasn't in their original climate calculations. These companies are now facing a choice between slowing AI deployment or quietly walking back their environmental commitments. The broader implication here is that we've been sold a fantasy about AI's sustainability. The industry has marketed artificial intelligence as a tool that will solve climate change, optimize energy grids, and create a more efficient world. But the infrastructure required to power AI itself is becoming a climate problem. This creates a genuine tension that tech companies can't simply engineer away with better chips or more efficient algorithms. As AI adoption accelerates across every sector, from finance to healthcare to consumer apps, we're looking at a future where the environmental cost of the technology itself becomes a serious constraint on how much AI we can actually deploy. That's the real story nobody's talking about. OpenAI proposed donating 5% of its equity to a US sovereign wealth fund. Sam Altman just dropped a proposal that could fundamentally reshape how Americans benefit from the AI revolution, and honestly, it's one of the most interesting moves we've seen from a tech CEO in years. OpenAI is proposing to donate 5% of its equity to a US sovereign wealth fund, which essentially means giving the American public a direct financial stake in one of the world's most valuable AI companies. This isn't just corporate charity, it's a calculated move that addresses one of the biggest criticisms facing Silicon Valley: that ordinary people are locked out of the wealth being generated by transformative technology. To understand why this matters, you need to grasp what's actually happening here. OpenAI has become arguably the most important AI company on the planet, valued at over $150 billion and controlling technology that's reshaping everything from software development to creative industries. Historically, only venture capitalists, employees, and early investors get rich from these breakthroughs. Altman's proposal flips that script by suggesting the government should hold equity on behalf of all Americans, creating a revenue stream that could theoretically fund public services or reduce the national deficit. It's a way of saying, if we're all going to be affected by AI, maybe we should all benefit from it too. The broader implications here are genuinely significant. This proposal signals that even tech's biggest players are recognizing a legitimacy crisis, the feeling that AI's gains are too concentrated, too exclusive. If this actually happens, it could set a precedent for how other transformative technologies get distributed. We're talking about a potential model where breakthrough innovations don't just enrich a small circle but contribute to public wealth. Whether Congress actually creates a sovereign wealth fund or whether this remains a symbolic gesture, Altman's proposal has opened a conversation that Silicon Valley has been avoiding for years. And that conversation might matter more than the equity itself. Microsoft launches its own AI deployment company with $2.5 billion commitment. Microsoft just dropped a $2.5 billion bomb on the AI infrastructure game, and this move tells us everything we need to know about where the trillion-dollar tech race is actually heading. The company is launching its own dedicated AI deployment division, joining Amazon, OpenAI, and Anthropic in recognizing that building AI models is only half the battle. Actually getting them into the real world at scale is where the real money and power lie. This isn't some minor corporate restructuring, it's a fundamental shift in how big tech views artificial intelligence as a business. Here's what's really happening beneath the surface. For years, we've been obsessed with who builds the biggest, smartest AI models. But the unsexy truth is that deployment infrastructure is becoming the actual bottleneck. You can have the world's most impressive language model, but if you can't reliably run it on millions of devices, integrate it into enterprise systems, and keep it running 24/7 without melting your data centers, it's worthless. Microsoft is essentially saying they're not going to depend on third parties for this critical piece anymore. They're building their own stack, their own supply chains, their own everything. It's vertical integration on steroids, and it mirrors what Amazon did with AWS decades ago. The broader implication here is that we're watching the AI industry mature from the hype phase into the infrastructure phase. The winners won't necessarily be whoever invents the coolest technology, they'll be whoever controls the pipes that deliver it. Microsoft, Amazon, and these other players are essentially building the railroads of the AI era. For startups and smaller companies, this is both terrifying and clarifying. You can still innovate on models and applications, but you're increasingly doing it on someone else's platform. That's the real story of 2020's AI landscape, and it's only going to accelerate from here. Tesla saw a massive sales jump in the second quarter. Tesla just crushed expectations with over 480,000 electric vehicles delivered in Q2 2026, and this isn't just another quarterly win, it's a signal that the EV market is fundamentally shifting. The company's success hinges on two strategic moves: aggressive geographic expansion into emerging markets and the aggressive pricing strategy that made the Model 3, Model Y, and Cybertruck accessible to mainstream buyers rather than just wealthy early adopters. This matters because it proves that electric vehicles can compete on price, not just on environmental credentials or cutting-edge technology. What's fascinating from a business perspective is how Tesla weaponized its manufacturing efficiency to undercut traditional automakers who are still struggling with EV profitability. By flooding the market with cheaper versions of proven models, Tesla essentially forced the entire industry's hand. Competitors now have to choose between matching prices and destroying their margins, or watching market share evaporate. The Cybertruck's inclusion in these numbers is particularly telling, since that vehicle went from being a novelty to a volume player, suggesting that even unconventional designs can achieve mass market appeal when the price is right. The broader implications ripple far beyond automotive. This quarter demonstrates how AI-driven manufacturing optimization and supply chain management can create competitive moats that traditional companies simply can't replicate quickly enough. Tesla's ability to iterate rapidly, reduce costs through software and automation, and scale globally puts pressure on legacy automakers to fundamentally rethink their operations. For the tech industry watching this unfold, it's a masterclass in how vertical integration and software expertise can disrupt hardware markets. The EV transition isn't coming anymore, it's here, and it's accelerating faster than most analysts predicted. Rivian raises EV sales forecast as Q2 production ramps up. Rivian just dropped some genuinely encouraging news that signals the EV maker might finally be hitting its stride. The company raised its sales forecast for 2026, expecting to deliver thousands more vehicles than previously projected, and the catalyst here is the successful launch of their R2 SUV last month. This matters because Rivian has spent years fighting skepticism from investors and analysts who questioned whether the company could actually scale production and compete with Tesla's manufacturing dominance. A revised forecast upward is the kind of concrete signal that separates hype from actual execution. Here's the business context that makes this significant. The R2 is positioned as Rivian's mass market play, priced lower than their flagship R1T truck and R1S SUV. This is crucial because the EV market is increasingly competitive, and companies that can't move down the price ladder tend to get squeezed. By ramping up R2 production in Q2, Rivian is proving they can manufacture vehicles at scale while maintaining quality. That's not trivial. We've seen multiple EV startups stumble when trying to transition from limited production runs to actual volume manufacturing. What's interesting from a broader tech perspective is how this reflects the maturing EV landscape. We're past the phase where simply announcing an electric vehicle gets you venture capital and media attention. Now it's about execution, profitability, and whether you can actually compete on cost and efficiency. Rivian's improved forecast suggests their manufacturing processes are improving, their supply chain is stabilizing, and demand for their vehicles remains solid. That's the kind of operational excellence that separates the companies that'll survive this decade from those that won't. Enterprises lost Claude Fable 5 for a few weeks. New data shows 2/3 had already built their hedge. Hashtag Claude Fable 5 vanished, and enterprise AI just had its wake-up call. When the US government quietly yanked Anthropic's Claude Fable 5 offline in mid-June without warning or explanation, it exposed something the tech industry had been quietly preparing for. Nobody can afford to bet their entire AI strategy on a single model anymore. For 2 weeks, enterprises that had built their operations around what many considered the most capable AI model on the market were left scrambling. Then China's Z.AI filled the void by releasing GLM 5.2 as open-source software, and suddenly the geopolitical chess match around artificial intelligence became impossible to ignore. Here's what makes this moment significant: 2/3 of enterprises surveyed during this exact window had already diversified their AI infrastructure before the outage even happened. That's not coincidence. That's institutional memory kicking in. Companies watched what happened with other critical technologies, cloud providers going down, APIs changing their terms overnight, open-source projects getting abandoned, and they learned. They're running Claude alongside OpenAI's models, alongside open-source alternatives, alongside whatever emerges next. It's defensive, it's expensive, but it's becoming the cost of doing business in AI. The broader implication cuts deeper than just redundancy. Export controls, geopolitical tensions, and the speed at which new models can emerge mean that the era of single-vendor dependency in AI is over before it really began. What we're watching is the enterprise world treating AI like they treat electricity or internet connectivity, critical infrastructure that requires multiple sources and failover systems. That changes everything about how companies will invest in AI, how startups will position themselves, and ultimately how the technology gets distributed globally. The Claude outage wasn't a bug in the system, it was a feature revealing itself. Thanks for staying updated with Neural Brief. Hit subscribe and enable notifications so you never miss tomorrow's AI breakthroughs. See you next time.